Hello and welcome. You're watching KYC, which is Know Your Company. I'm Harsh Saita, and we're going to focus in on Advait Energy today. It's an interesting company from a perspective that the market cap is around 1100 crores, so quite small in terms of size, large opportunity available. It's engaged in providing products and solutions for power transmission and renewable energy. Currently more focused on power transmission, less focus on renewable energy, but they're growing renewable energy on a fairly healthy clip in terms of the growth rate. It's established in 2010. Transition, earlier was doing consulting and trading, now has transitioned to manufacturing since 2014, and lots of power components is what it manufactures. The intent of the management when it shifted focus in 2014 was to take care of import substitution, to basically try and plug that gap, that this is of course basis management con calls. But power transmission, substations and telecommunications infra is what the company is currently completely focused on. Renewable energy is the other focus area which has come into focus since 2023. 90% of the total revenue comes from transmission and related products. Let's pull up the business segments FY24 versus FY25, and what you will see, optical ground wire was 72% of the top line in FY24. FY25 9 months, that has shrunk to 44%. Let's focus in on what are those aspects therefore that have gained ground. You've seen power discom, especially with regard to EPC, which has gone up from 4% earlier to 23%, which is part of the yellow part of the bar chart, the pie chart that you see in front of you. And the other piece is with regard to stringing tools. Stringing tools are basically used for both construction as well as servicing of power lines which go through, so largely into transmission again. And even within stringing tools, the market share of this company is very, very high. Nearly 30% market share is what it commands within this. So it's a great play if you're looking at power as a segment, and this could be one of those companies that you'll want to look out for because it has such a high focus on power. They're expecting renewable energy to surpass the transmission segment revenue in the future. So you'll largely see the growth coming in from renewable energy in a large fashion going forward. But let's try and break this one down. So this is about all that the company is doing. It's into EPC, just to try and break it up, it's into EPC, it's into transmission products and into renewable energy. So those are the three larger focus areas. But let's talk about what are the metrics that we look for today with regard to this particular company. One, we'll do an income statement check very quickly, look at how fast the growth of the company is, balance sheet, cash flows, all the regular metrics, and thereafter the return ratios. But this is a unique kind of a business, and I did break it down. And therefore, we'll have shareholding and street cred, which is fine. But we'll talk about guidance, because pure comparison, we won't have a absolute like for like in this particular segment. And because renewable energy is such a small component, not fair to compare it with other renewable energy players. And we'll also look at what the street coverage looks like. So those are the 8 metrics that we'll look at. And to try and break these down, we have with us Anushi Vakharia, who tracks the sector closely. Anushi, you've pulled out some of the numbers here. Talk to us about what comes out of the income statement in your view.
Right. So firstly, when we are looking at the revenue statement, the income statement and revenue, we are seeing a stronger footing. We've seen about growth of 101% in FY24. Even in last year or so, we are seeing 43% of growth coming for the business. In fact, if you look the 3-year CAGR for income statement, we are seeing that the revenue growth has been in the range of 53%, while PAT we've seen in the range of 64% of a CAGR growth that we are looking in terms of where the PAT is concerned. In fact, you know, if you talk about the margins also, now the company's margins stood in the range of 15% in FY22, which has moved upwards in the direction of 17%, 17 to 18% of range is what we are seeing. The company did mention that in the near 1 year or so, they expect to continue on a similar margin trajectory, which it has been maintaining. But after that, they might see some dip in terms of where the margins are, and overall margins would be in the range of 13 to 18%. So that's the kind of guidance that they've given in terms of how the margins are going to be, because non-renewable energy is going to be one of the biggest segments going forward, which we'll discuss about later. So with the segment being there now, it would be interesting to see the margin picture and also on the kind of contribution that the business has. Quickly, just talking about the 9-month picture, the revenue has seen about a 37% growth, while margins were down about 137 basis points to 15.3% as compared to 16.7%, and net profit we saw about a 26% of growth. So this is overall income statement check, Harsh, that we are looking at.
Yeah, clearly a thumbs up, because the kind of growth that it's clocked, 3-year revenue CAGR of 53%, 3-year PAT CAGR of 64%.
Absolutely.
And going into renewables, so so positive on that count. Difficult to point or poke holes into these kind of numbers. But let's look at the balance sheet now. The fixed asset base has grown quite sharply, and they've invested well. From 14 crore in FY22, the fixed asset base currently stands at 35 plus crore. You're looking at how this is being funded. Equity, you're seeing nearly 11 crore of equity on the balance sheet, some bit of equity raise also. Reserves have also shot up dramatically, of course, on the back of decentish profitability, but also because other equity within the balance sheet has gone up. Debt is the other component which has gone up quite sharply. So it's gone up from nearly 6 crore to 43 crore. So the debt number really going up in a sharp fashion, because they are investing, and they're investing in renewable energy. They're investing in transmission. Those are the two pockets where they are putting a large part of this money in. Largely a thumbs up where balance sheet is concerned, because you're seeing debt which is not too high. You're not seeing equity which is a concern. Your debt to equity levels are quite reasonable, and the growth clip is quite substantial. And therefore, that balance sheet looks good. I'll also quickly take you through cash flows. Now, in terms of cash flow from operations, you've got a negative 10 crore there. And that's also because your inventory levels have gone up. Maybe not inventory levels, but your receivables, your trade receivables have gone up quite sharply when you're looking at it all across the year. So FY23 also they went up, but FY24 was more substantial. But your cash flow, your net cash flow is still positive, because they've raised money. And we know that. We saw the kind of debt levels that the company has seen. And therefore, that the raising of money has helped it stay positive where net cash flow is concerned. So a neutral on this count. We'll have to wait and watch as to whether it can generate cash flow from operations. Once operations also start to normalize, once top line, which is growing at 100% in FY24, starts to normalize, whether they can continue to generate a healthy cash flow is what I would look forward to. But let's talk about return ratios on all the investments that they are making, Anushi.
So right, we did address about the 64% of CAGR growth that the company had in terms of where the PAT is concerned. That is clearly reflecting in the kind of return ratios that we are looking at. So if you see what has happened in FY22, their ROE, that's a return on equity, stood at about 21.6%, which eventually moved to 19.2%. But FY24 onwards, we've seen a sharp uptick in terms of where the ROE and the ROC numbers are. 28.7% is the ROE number that we are looking at, while for the capital employed, the return on capital employed, that stood at about 31%. We've not seen a lot of players in this field with the kind of numbers that we are seeing in the range of 25% plus ROE, ROCs that the company is making. So very healthy sort of ratios overall that we're looking in terms of where the return ratios are.
Yeah, whether sustainable or not is again something worth a watch, but difficult to poke any holes in this one either. So it's a thumbs up on that count. Let's look at shareholding. Shareholding has come off a little bit from the highs, but now at 69.5%, quite steady. It was 73+%, mind you, but it's come off slightly, maybe in this financial year, from the June quarter onwards, and therefore you're seeing that kind of number there. Also, no FIDI investment, because it's a very, very small company, understandably so, and therefore meaningless in terms of the FII combination here in the shareholding, and the balance is largely held by public. That's how it is. Let's also quickly look at street cred, and I'll take you through that one. The last 6 months, you're looking at negative 40% returns. last 1 year, negative 9% returns. This has underperformed both the Nifty small cap as well as mid cap indices. Therefore, a thumbs down on this one. But it's been a great compounder over the last 3 years. It's been 18x in the last 3 years. That kind of a sector, that kind of a space, a turnaround in the power segment is what we've seen over the last few years. And this one benefiting from that tailwind. But 18x returns, can that sustain? Well, what does guidance suggest?
You know, just on the quick point about shareholding, we've seen, you know, you said 73% and then eventually that moving to 69%. The company did say that from now onwards, they're not looking for further dilution in terms of where the equity is concerned, in terms of where if there are any fundraising plans or so. So that was something which was interesting as well. But other than that, if you're talking in terms of where the top line is concerned, we are looking at a growth of around 50% in terms of the revenue which is there. The company has plans to maintain the kind of growth momentum that it has seen in the last 5 years as well. So they see, and this would be aided by the non-renewable energy segment, which is the big upcoming segment for the business. So there they are seeing about 40 to 60% growth coming for the business. Just quickly walking through what are some of these plans in the non-renewable energy that they are looking at. Now they're going to be setting up a manufacturing unit at Ahmedabad. This is for manufacturing 300 of megawatts of electrolyzer under the PLI scheme by SECI. Other than the initial production expected to start from FY26 onwards. Other than that, they're also in partnership. They've also entered a MOU with Teco Group to develop fuel cell products. So for the same fuel cell assembly and manufacturing facility, operations are to begin from 26-27 onwards as well. So once these facilities are on stream, we'll see a higher mix for the non-renewable side. The eventual plan is what Harsh said before also, power transmission currently contributing about 90% of the mix. But eventual plan is to see a 50-50 mix across these two segments. So it is interesting how the new segment is going to pick up and what is going to be the pipeline in terms of order opportunities for the business for these two segments which are there.
Okay, so that's one piece of it. Let's also quickly look at what the street coverage is like, and the street coverage currently not present. It's a 1200 odd crore company, so give it to them that likely the street not really interested, but also this leaves some bit of room open to the fact that because there is no coverage, you may likely not see the kind of rigor with regard to disclosures and corporate governance. And therefore, you might want to factor that as part of your thesis. And therefore, we don't give this a negative because company is too small to cover for many analysts. But at the same time, it's not a positive. It's largely a neutral is what we give on this one. No street coverage. Okay, so we've tried to break down the business the best we can, but let's move on. Let's hear it from the management themselves. We caught up with the promoter and MD, Shalin Sheth, and here's what he had to say on the company's growth prospects going forward. Listen into a slice of that conversation.
Since we have been growing with a rate of 30 to 45% in last 3 to 5 years, so the main growth has came from our PTS division, that is Power Transmission and Solutions Department. We are finding a great opportunity in this segment itself, and we have got a manufacturing and EPC segment within this PTS part, and we are also innovative various products. So every second year we are coming with a new manufacturing line. So our strategy is that to create the entry barriers and to enter into the business where there is an entry barrier and look forward for the growth where we can sustain the business on its own. And we have been quite successful for adding the new product lines. And that's the reason our company has been able to give this growth. At the same time, from the NRE division, that is New and Renewable Energy, we put up the division in 2022-23. And our plan is to manufacture the green hydrogen equipments like electrolyzers and fuel cell. So that is one part of the NRE. We are also into battery energy storage and EPC solutions for the solar. And we are also providing the carbon solutions. So these three segments where we are looking forward for the growth of next 3 to 5 years. And we believe that in next 3 to 4 years, we'll be able to have the equal revenue from the PTS and the NRE both the side.
So it is a 50-50 mix that you're looking from 90% mix which is currently there in power transmission to a 50% is the mix that you will be looking in the next 2, 3, 4 years. Want to understand, considering that there would be a 50-50 mix forward for the business, how would the margins shape up? Would they continue to remain in the 15 to 17% of range? Just want to get a perspective on this because what we have seen from 2022 onwards where the margins were in the line of 13% and subsequently we are seeing it going upwards in the range of 17%. Want to get your sense on how the margins have shaped so far from the last 2-3 years, and what's the picture going to be forward?
Looking to the current order book and the market that is offering to us, we believe that we'll be able to maintain the same profit margin for our PTS division. And for the NRE, based on the product mix, initially for 2 to 3 years, we'll be having little down in the margins, but we'll be looking forward more into manufacturing side of the NRE too. So believe that after 3 years, our margin story will be continued for the NRE side also.
So, Mr. Sheth, well, currently, if you look at the 9-month picture, your margin stood at about 15%. This is as compared to, if you take the last year in consideration, that was around the range of 16.7%. Want to understand the current blip which is there. Is that the reasoning that you're giving, that since the new energy division is still developing, in the next 1 year or so, we can see there could be some margin pressure, and then from there onwards, we'll see a gradual pickup?
For the next 1 year, we don't see much margin pressure, but maybe for in a short horizon of 2 to 3 years, if we need to take some of the projects, it may have a little down in the margin for the NRE side, but overall, we'll be able to maintain the margin.
Okay, and can you give us a range as to what could be the range when you see in the next 2 to 3 years where there could be some pressure? What's the kind of margins that you're looking at?
Our range on a company basis will be about 13 to 18%.
Okay, so 13 to 18% is what we are seeing going forward for the business. Now, as we have seen in the last couple of months, there have been significant developments for the company in terms of the new and renewable energy. You've cited out your future plans also. In 2027 is 1 year that we should be watching out for when some of these key facilities would be on stream. Can you talk about the recent one, which is the PLI that you had recently announced, and this is for which you're also setting up a new facility in Ahmedabad? Want to understand more on this development, how this would lead to incremental revenues going forward for the company, and what could be the expectations here from the overall growth picture for the business?
Our new facility will start giving the manufacturing and revenue from the year 26-27 onwards. And we believe that the facility should be ready by that time. And we believe that we'll be also required to provide as per the market requirement, because slowly the market is also gearing up. As I told you that overall our NRE and PTS division will be having the equal market share, equal product mix in the next 2 to 3 years, maybe in 4 years. So we are looking forward with a growth of 40 to 60% with the NRE business in next 3 to 5 years.
So 40 to 60% is what we are seeing from the NRE business. But if we take the whole overall picture in consideration, considering the power transmission segment as well, what is the kind of overall revenue growth that you're targeting?
Looking to the order book and kind of orders that we're expecting, and looking to the deliverables of those orders, we believe that we'll be able to maintain this growth of last 5 years we've been maintaining in an overall company size.
Okay. Yes, please go ahead.
Or maybe in some year it may have little change, it may also exceed based on the market and requirements.
Okay, that's fair to understand. Mr. Sheth, considering that you're marking a foray, your NRE is still a smaller segment for the business, wherein you're seeing about a 50% of a share going forward. I also want to understand, are there any challenges or concerns that could be upcoming in these next 2 to 3 years? Want to get a sense on how the competition is as compared to your business. Just want to see what could there be some of the concerns be.
Looking to the market and size it is offering, and looking to our ability and our cost structure, for next 3 to 4 years, for the numbers that we are working, we don't see a very fierce competition, because the market has got enough to offer in terms of growth, in terms of opportunity. So we don't find a very fierce competition while achieving our numbers for next 3 to 5 years.
Okay, so if you take the current total order book into perspective, firstly, want to get your sense, what is the total order book going to be? What's the current order book, and what is the kind of orders in pipeline which are already there across the segments? If you can give us a breakdown between the NRE and the power transmission as well. Want to understand from here on, in this order book division that we are seeing, how much of a role is from the government side also? Like how dependent are your inflows on the government tenders? If you can get a perspective on that as well.
Very interesting question. See, ultimately, we have been working in a field of power and power transmission. So government role is very important because as far as the government plans are concerned, our business is linked up with the plan of the government. But it is also offering the equal private opportunities as far as the various products, especially for the ERS segment, especially for the NRE segment. So we believe that our product mix will be 60 to 65% from the government projects and 30 to 35% will be the private business. That's what we are looking forward. Looking to the horizon of 3 to 5 years, we are looking forward about about 800 to 900 crores business each site within Advait. And if you just look at the market size for the NRE side, by achieving these numbers, will be hardly achieving less than 1 or 2% of the market. So we don't find a fierce competition, and we are building on capabilities, we are building on the team, we are building on company. So we are confident about this.
Mr. Sheth, considering that 60 to 65% is from the government side, in the fourth quarter, there were some concerns on there being some third quarter, there being some lag in terms of whether government tenders are in place. Did you also feel that there was a lag in terms of the tender approvals which were there? What is the current sense that we are making in terms of the order inflows which are there?
Looking to the current scenario, in fact, we are finding more and more opportunities, and we have not found any lag in the orders in the field where we are operating. So we are finding these quarters as most exciting quarters in terms of opportunities, also from government side and also from the private side.
Okay, so considering that you have strong plans for the new and renewable energy, which you just mentioned, the PLI one already there, there's also considerations of fuel cell assembly facility also coming on stream in 27 onwards. I want to get a sense on the capex number as well for the next 2 to 3 years. How is the capex going to be shaping like? What are the kind of cash flows and what is the debt picture also going to be building? Like if you can give us more details on this.
For the year 25-26, we are not looking forward for further equity dilution unless it is required on a specific exciting opportunities. We may have some debt on expansion of the electrolyzer manufacturing. We are looking forward total capex for the company about 200 crores in next 2 to 3 years.
Right, that's the management of Advait Energy talking to us exclusively with regard to all of their plans and what we can expect from them going forward. Let's look at the metrics once before we close the show. And, you know, we've spoken about all of this. Income statement, very strong growth, clear thumbs up. Balance sheet also robust in terms of debt to equity, low risk in that sense. And no further equity dilution also expected. So that's also a thumbs up. Cash flow, neutral, want to see better cash flow from operations start to trickle through and some stability with regard to growth there. Return ratios very, very strong, you know, anything between 20 to 30% on the ROE and ROCE metrics over the last 3 years, and therefore a clear thumbs up there. The other four, shareholding is near 70%, and that's a positive. Street cred is a thumbs down because of the last year's performance lagging the street, and therefore can guidance translate to execution will be the big question here. Guidance. And that's the key. Very, very strong guidance, large changes with regard to business model, and therefore we'll want to wait and watch as to whether this actually translates. And last point is with regard to street coverage. No street coverage, be cautious, therefore do your homework before you quickly look at how to invest and how much to invest. 5.5 on 8 is how the rating stacks up. And of course, we hope that this was helpful. From Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit.